In today's webinar, we're going to talk about all things special needs trusts. We're going to dig deep into what is a special needs trust? How do you go about using one? Why would you use one? Do you need a special needs trust in addition to an ABLE account, or can you use one or the other sort of interchangeably? We're going to talk about how to fund special needs trusts, how to not fund special needs trusts. We're going to talk about first party, third party special needs trusts. We're going to talk about pooled special needs trusts. All things special needs trust. And with that, we will turn to our resident expert. My name is Keith Caldwell. I am a parent just like most of you guys out there. And I am learning and listening from Ryan as well, because I have a lot of questions myself as I plan for the future when I'm gone. So with that, I'll let Ryan go ahead and introduce himself.
Yeah, I mean, that list from Keith, I'm tired myself just thinking about it. Holy mackerel. But I appreciate everybody sending your questions in. If this is the first time that you're coming to this webinar, thank you so much. Keith and I have been blessed to be doing these for folks since I believe 2013, Keith, if I remember correctly. So we've gone through quite a number of iterations, and we've stumbled on doing some of these question and answer sessions. Because, we want to make sure we're answering questions that you guys have.
Let's talk about two things that I saw questions that came in. We're going to group them all together in the interest of time. Then I'm going to get to you guys over there. I haven't forgot you, but I'm giving priority to the people who submitted them first. So there's a question of taxation. There's a question of funding and how not to fund. I know you and I have talked about how not to fund, because I had a lot of creative ideas where you said that would be really idiotic, Keith. Well, thank you for letting me know that in advance. Well, you may not have said it that way, but you told me that.
I hope I didn't, idea. But to you, I might have.
You might have.
Because you and I, we can talk to each other like that, which is awesome.
Right. I'm always trying to find creative ways to pass to the next generation.
Yeah.
And Ryan said, well, this is how it's going to apply if it gets taxed. So why don't you share with us the tax implications of special needs trust, because I know it has the compressed thing, and how to fund and what kinds of things not to fund. Can you talk briefly about that? And this is sort of answering all the questions relating to that came in. Okay, and then I'll go over here to some of the questions that came in.
Yeah, so obviously there's all sorts of different ways to fund it. I think what it comes down to is what's the most efficient way to fund it, for families. And so, one of the things that I see a lot is obviously so many folks just in our everyday, work for a company. And when you work for a company, you sign up for the retirement plan. Most of them are called a 401k, and you start putting money in there. And you like it because you don't pay taxes on the money each and every year that you make a contribution. What we forget about is that money is growing, yes, tax deferred, but at some point will be taxed. And if all your money sits in that kind of an account, that's probably going to be the account that's going to end up funding the special needs trust, just for lack of anything else being there, just because you didn't think about it until later. And so what happens with that account is it's never been taxed. And so when you take it out for retirement, whatever you take out gets taxed as income. If you die, and that's the funding mechanism, which for a lot of people it is, until they see us and realize, holy mackerel, that's going to cost me a lot of money, is that money, again, when you take it out, it's going to be taxed at your income tax rate. Well, if you leave that to the special needs trust, any money that is coming out of that every year and into the trust, let's say, the what's called a beneficiary IRA is now owned by the trust. Well, the trusts in general have what I call compressed tax brackets, meaning that you just run through them faster until you get to the top. Right. So for an individual, and I'm not going to get the number right, so please don't email Keith. Please don't Google it and email Keith. Ryan doesn't know what he's talking about. But let's say for an individual single person, the top tax rate's $400-something thousand. For a married couple, the top tax rate, the top tax bracket right now is somewhere you have to earn a little bit over $600,000 before you hit that 37.4% top tax rate. Well, inside of a trust, you run through those brackets and you get to the top tax rate at about $13,000 of income.
Ouch.
Yeah, I'm wiping my eye to give you time to digest that. $13,000 of income, you hit the 37.4%. And if you live in a state with state income tax,
Like California,
yep,
New York.
like California, like New York, there's only 3 of them, I think, that don't. So most people are going to live in one that does. Plus right now, most of them will also have what's called the 3.8% net investment income tax as well. So you start adding those up and you're like, holy cow, that might be 50%. And we're at the lowest, the third lowest ever income tax rates in the history of income tax rates since like 1903. Mm-hmm. And where are they headed? $30 trillion of debt, low income taxes. They're probably going up, right? At least the top tax rate will. And again, a lot of us individually aren't worried about that, but we are for the special needs trust component.
Give an example. So if you have $100,000 worth of income into that, and it's compressed, they take the first 13,000 off, right? To make that.
Well, it's not off. I mean, it runs through the bracket. So 0 to 2,000, then 2 to 4,000, and then so it's not 0% to 13,000.
They're taxing along the way. Well,
they're taxing, yeah.
For my simplistic mind, okay, let's say it's only on the top thing. So this is just not accurate, but just for simplicity. So that means that 100,000 in income, take off the first, let's say 10,000, that's 90,000 at 50% tax rate. So you're forking over 45,000 to the government. Is that what you're telling me?
Yep, possibly. Yep.
Wow.
Yep. Now again, there can be some fancy accounting you might be able to do depending on what else is owned in there. But anyway, so a 401k can be a good tool, but it might not be the best funding tool. Now again, when that 401k goes in as a beneficiary to the special needs trust, there's also rules from the Secure Act at the end of 2019 that came into play that still allows a special needs trust, because the beneficiary is an individual with disability, to take what's called a required minimum distribution, right? So you don't have to take it all out in a compressed time period, whereas before that you did. So that's a benefit to that, but you still have to take out some money out of it every year. And whatever that money you take out of the beneficiary IRA inside the trust, even if you don't take it out, even if you just put it into a checking account owned by the trust, you still have to pay taxes on it. So it's a very inefficient tax tool. And so you may want to consider other options, right? So, one of the most efficient ways to do it, which people hate it, they don't like it, they hear the term, you want to shut down the computer and turn it off. But I'm just here to tell you the truth, is life insurance. I mean, nobody likes to talk about it. I don't even like to say it because you're going to hang up on us, right? But from a tax code perspective, I'm just talking tax code, right? Who cares what it's called? From a tax code perspective, any money from life insurance death benefit flows income tax and capital gains tax free. So if you had $100,000 life insurance policy, it's going to be $100,000 for your child. And it's going to fund it within 7 days. So it's also very liquid. So if you have a house that's going to fund it and that house has to sell, that's not going to fund it very quickly, except in this market. That probably fund it within 7 days too. No, it would take longer to close. But anyway, you have to look at probably for a lot of families, it might be a blend of different things. There can be advantages of different investment accounts, right? Some of those can have some tax advantages when they go from generation to generation. Those are being heavily looked at right now from a tax legislation level. But again, nothing has changed yet. But that's one of the one of the things to consider when you're funding the trust is a lot of that decision comes down to tax efficiency on how things generationally transfer in the tax code and how quickly they do so that your child doesn't have an interruption in care and support needs that you're paying for up and above government benefits. Because once you're dead, as Keith knows, because he just did this with his brother for his father, things are frozen. Frozen. Unless they're titled properly or unless there's a beneficiary attached to it directly. And so if it's frozen, the question is, if you didn't plan ahead and understand those rules, who's going to pay for those support needs in the next month?
Just an update. We just had our first hearing on our probate situation. What's that? 9 months, 10 months after my dad died. So we just had our first hearing. So we're probably still another year out from getting any of those funds out. So
well, and I'm working with a family right now that I met with them earlier today. It's the same thing. They're getting an inheritance, but it's been a year since their family member passed away.
Yeah.
And it's not a complicated estate, guys, but that's how slow it works. And so again, you have to look at what your assets look like and how they work, not only while you're alive, but in that moment that you die and this plan needs to be functional. Right? And that's just part of what we don't look at very often. And most of us don't know because we haven't died. I know that sounds so stupid that I just said that like that, but it's true.
It is true.
We haven't died. Our spouse hasn't died, right? We haven't been through it, so we don't know, but that doesn't mean it still doesn't exist. So it's your responsibility to know, which is why I love the fact you're here. Hopefully you didn't hang up on us, but because you want to learn, which is great, but you also have to take action, which is why How to Secure the Future is here, is to help you on that first step to take action at a very cheap price to learn and to go through some action steps to start to put together your plan. That's why we at a Special Needs Plan are here. If you're going for that next level of, hey, I actually need a guide for this. I mean, there's help out there. You do not have to be on your own. That's what Keith and I are here for. So, if you're struggling on your own, and please don't kick me, it's really your choice. It's your choice that you're struggling on your own because you don't have to.
Right.
People are here to serve you guys.
Okay. All right. I'm a little nervous about this, but give me a chance. I am going to try to get some of those questions that I see over there. So Ryan.
Let's do it.
Ryan and I didn't have a chance to do our pre-webinar technical check-in, so I'm going to try something here. Bear with me.
Here we go, everybody.
I know. I'm nervous. You know how I feel about that. I like to test all that stuff. So here we go. I'm going to try to bring you on. Is that you?
I stress Keith out, everybody.
No, that is not you. I got to sign.
Hey, Alan and Tracy, thank you so much. That's very kind of you.
Well, I don't think that's going to work. We're going to have to do that something else. Hold on, everybody. All right, Ryan, we're going to have to, I'm going to have to go to the questions there because and we'll talk later. Okay. All right. So I see some questions came in. Carolyn Rogers says, I understand the ABLE account grows tax-free versus the special needs trust is taxable as a trust. Is the ABLE account preferred with assets up to 400,000? Well,
I would say kind of what we talked about before, Carolyn, is I would say it's a great tool to keep at $100,000 or lower, due to the fact of the Medicaid payback provision inside of an ABLE account in most places, from a federal level. Hopefully that changes, and also from an SSI level, that supplemental security income still being there. So for now, again, barring knowing the rest of your situation, as kind of just a general rule, I try to keep ABLE accounts under $100,000.
Right, because you do lose some of those benefits, right?
Yep. Now again, yeah. So we could go into a whole nother thing if, as parents retire, that decision might change.
Right. We have talked about that in previous webinars.
We have.
And just
Yeah.
remember, guys, you can always look at some of our historical webinars on pooled trust,
Yes.
special needs trust, on the importance of an
Able
able
accounts.
account and special needs trust at the same, because we get in depth on those. At the request of some parents last time, they had suggested that we break our question and answer webinars to a specific topic, because we did our last one that was on everything and it was all over the place.
Right.
And I
It was.
we didn't know how that was going to play out, but we've learned our lesson from that. So Slim Dog, I like that name.
Hey, all right.
Slim Dog, but wouldn't you want to fund that special needs trust at death to avoid the massive tax drag, perhaps from a revocable living trust?
Again, depending on your individual situation, you might not want to put a lot of money in that special needs trust early on in your life. Yes, you're right, because you have to manage that trust with taxes in mind, just like we talked about. When you fund it, you have to fund it with taxes in mind. But then, just like you said, Slim Dog, you got to manage it with taxes in mind. So for the most part, usually we're looking at parents saying we want to fund it later in life with the majority of the money. What we're saying is, just to prepare the other people for less things to do, is, hey, if you open a special needs trust account with $100 and just keep it in a money market or a checking account, there's no taxes to pay. And it's open. Yeah, is it a lost $100? Yeah. But man, those next people are going to praise you for doing it.
Because you're going to have already got the tax ID number and all the things to create it, which if they don't know what they're doing, then they're going to have to learn at the same time they're mourning your loss. So
Amen.
for that reason, I agree. So